sustainable U.S. economy. At the board and reserve banks, students also get hands-on opportunities.
Fucking A, finally.
Internships and
Hello?
participation on student boards, which introduce them to key economics
God
concepts and
damn.
potential careers in economics and finance. Consumers are empowered to make sound financial decisions through the availability of easy-to-understand resources that explain personal finance concepts, the broader economy, and the Federal Reserve's role in it. Federal Reserve education is committed to equipping educators, educating students, and empowering consumers when it comes to understanding and participating in our evolving economy. For more information, visit federalreserveeducation.org to find links to resources and Reserve Bank programs offered near you, and follow Federal Reserve Education on Twitter at @FedEconEd.
What is the Fed?
So what is the Fed?
What is the Fed?
What is the Fed? The Federal Reserve, often referred to as the Fed, is the central bank of the United States.
Congress created the Fed in 1913.
Alright, 50 basis points, baby.
And financial system for our nation. The Fed includes the Board of Governors in Washington, D.C., which has 7 members, including the chairman and vice chairman.
I know.
The members of the board are appointed by
I ain't no
the
fucking nerd.
and confirmed by the United States Senate. The Fed also includes 12 regional
Of course I know that.
The reserve banks serve as the
Silly
central bank's
goose.
operating arms and also gather economic information from all over the country.
To help the Fed both monitor the economy and get the broad input necessary
To develop and implement effective U.S. monetary policy.
Today, the Fed performs a number of important functions, all with the ultimate goal of promoting a healthy U.S. economy.
One of the Fed's most recognizable functions is conducting U.S. monetary policy, which involves influencing interest rates and the availability of money and credit in our economy.
Congress has tasked the Fed with implementing monetary policies that promote maximum employment and stable prices.
High levels of employment provide people with more economic opportunities, and stable prices promote growth.
By making it easier for households and businesses to plan for the future.
Monetary policy decisions at the Fed are made by the Federal Open Market Committee,
Which includes
Count 'em up. Count 'em up. Count 'em up. Count it. Holy fucking candle of doom. Uh-oh. Are we gonna squeeze these shorts? Come on, squeeze the shorts. Squeeze, baby. It's rallying time. Drainage. I abandoned my boy. I abandoned my child. I abandoned my child. I abandoned my boy. Let's fucking go. I abandoned my child. Come on, we got the 50 basis points, baby. Let's go. The news is out. It's out. It's out. Let's go. Let's go. I abandoned my child. I abandoned my boy. Come on, baby. Push. Squeeze the shorts. You gotta squeeze the shorts. We know it. We all know the news now. The uncertainty is done. We know what it means. Go up. I abandoned my child. I abandoned my boy. Down, 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 down. Boom, 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 boom. Wow. Come on, let's push. 420 just tapped it. Let's go, Spike. Come on. Let's go, dude. Let's go, dude. Pogu. What now? Hello, testing? What now? Oh, okay. That's weird. That's weird. Ooh, yeah. I gave my job and I found out someone been shame. It doesn't get no vibrant, no reckoning, no sickening. She's a fortune. Come on. Where's the pushing of the P? We gotta be pushing P. Is she a lesbian for P? She turned lesbian. Come on, Spy. What are you doing over here? We're holding the 21 up. Count 'em up. Count 'em up. Count 'em up. Count it. Nothing's happening. Hold that level. We gotta hold the level. 417.32. We gotta hold that, baby. Nice. God, it's amazing. Yeah, thanks. What's the deal here? I'm walking here. Another one. Another one. Another one. Come on, dude. There's no way this is going down, bro. There ain't no way, boy. There ain't no way, boy. There ain't no fucking way, boy. Wow, so brave. God, Spy, are you really tanking like this? You really gonna tank like this on me? Just testing this level? Yes. What a goober. You are terrific. I got the juice. I got the juice, 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 juice. Come on. There ain't no way, boy. There ain't no fucking way, boy. Let's go, spy. Push. Oh, oh my god. Oh, get off. Oh, baby. Men need to start making noise in bed. Come on, baby. Spy, what you doing? Oh, that was a nice test of that level of the 50 moving average, baby. That's beautiful. We're bouncing off of it. That's groovy. Make the shorts cover, dude. We gotta squeeze the shorts. No, you're done. You're actually cringe. Literally so cringe. Oh, baby. Let's go. You're done, kid? So cringe. What's so funny? Nice. Uh, uh-huh, honey. Ish money, ish money. Who you calling pinhead? Wednesdays are old folks' day? Ah, Nice. The days go by pretty quick? Yeah. Nice. Yeah. Wow. Come on, spy, push!
Even when it's like slow, it's like not even close to a slow, easy work Thursday. What the fuck? Why are you
I'm all
tying
tied
it up?
I'm a little tied up.
Fuck.
I know, my breath smells. Come on, spy, fucking push, baby. Yes! 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 Ooh. Keto. Oh, can you buy me some milk? 2%? Hell yeah. Just take my... I didn't really think about this. You could just take my card. It's freshly loaded up. It's just 9024. You'll remember. Sure. Like Cinnamon Toast Crunch. That, yeah, that'd be good. That's gonna be good. Yeah. I know. I saw the barefoot. I was like, oh, really went all out today. God damn it, I should have sold. Fuck, I knew I should have. Unreal, dude. Unfucking real.
From the standpoint of our congressional mandate to promote maximum employment and price stability, the current picture is plain to see. The labor market is extremely tight and inflation is much too high. Against this backdrop, today the FOMC raised its policy interest rate by a half percentage point and anticipates that ongoing increases in the target rate for the federal funds rate will be appropriate. In addition, we are beginning the process of significantly reducing the size of our balance sheet. I'll have more to say about today's monetary policy actions after briefly reviewing economic developments. After expanding at a robust 5.5% pace last year, overall economic activity edged down in the first quarter. Underlying momentum remains strong, however, as the decline largely reflected swings in inventories and net exports, two volatile categories whose movements last quarter likely carry little signal for future growth. Indeed, household spending and business fixed investment continued to expand briskly. The labor market has continued to strengthen and is extremely tight. Over the first 3 months of the year, employment rose by nearly 1.7 million jobs. In March, the unemployment rate hit a post-pandemic and near 5-decade low of 3.6%. Improvements in labor market conditions have been widespread, including for workers at the lower end of the wage distribution, as well as for African Americans and Hispanics. Labor demand is very strong, and while labor force participation has increased somewhat, labor supply remains subdued. Employers are having difficulties filling job openings, and wages are rising at the fastest pace in many years. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in March, total PCE prices rose 6.6%. Excluding the volatile food and energy categories, core PCE prices rose 5.2%. Aggregate demand is strong, and bottlenecks and supply constraints are limiting how quickly production can respond. Disruptions to supply have been larger and longer lasting than anticipated, and price pressures have spread to a broader range of goods and services. The surge in prices of crude oil and other commodities that resulted from Russia's invasion of Ukraine is creating additional upward pressure on inflation. And COVID-related lockdowns in China are likely to further exacerbate supply chain disruptions as well. Russia's invasion of Ukraine is causing tremendous loss and hardship, and our thoughts and sympathies are with the people of Ukraine. Our job is to consider the implications for the U.S. economy, which remain highly uncertain.
Rug pull.
In addition to the effects on inflation, the invasion and related events are likely to restrain economic activity abroad and further disrupt supply chains, creating spillovers to the U.S. economy through trade and other channels. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we're strongly committed to restoring price stability. Against the backdrop of the rapidly evolving economic environment, our policy has been adapting, and it will continue to do so. At today's meeting, the committee raised the target range for the federal funds rate by a 0.5 percentage point and stated that it anticipates that ongoing increases in the target range will be appropriate. We also decided to begin the process of reducing the size of our balance sheet, which will play an important role in firming the stance of monetary policy. We are on a path to move our policy rate expeditiously to more normal levels, assuming that economic and financial conditions evolve in line with expectations. There is a broad sense on the committee that additional 50 basis point increases should be on the table at the next couple of meetings. We'll make our decisions meeting by meeting as we learn from incoming data and the evolving outlook for the economy. And we will continue to communicate our thinking as clearly as possible. Our overarching focus is using our tools to bring inflation back down to our 2% goal. With regard to our balance sheet, we also issued our specific plans for reducing our securities holdings. Consistent with the principles we issued in January, we intend to significantly reduce the size of our balance sheet over time in a predictable manner by allowing the principal payments from our securities holdings to roll off the balance sheet, up to monthly cap amounts. For Treasury securities, the cap will be $30 billion.
Let's go, baby. Come on.
And will then increase to $60 billion per month. The decline in holdings of Treasury securities under this monthly cap will include Treasury coupon securities, and to the extent that coupon securities are less than a monthly
squeeze
cap,
fucking shorts.
Treasury bills.
Squeeze
For
those
agency
motherfuckers.
mortgage-backed securities, the cap will be $17.5 billion per month for 3 months, and will then increase to $35 billion per month. At the current level of mortgage rates, the actual pace of agency MBS runoff would likely be less than this monthly cap amount. Our balance sheet decisions are guided by our maximum employment and price stability goals, and in that regard, we'll be prepared to adjust any of the details of our approach in light of economic and financial developments. Making appropriate monetary policy in this uncertain environment requires a recognition that the economy often evolves in unexpected ways. Inflation has obviously surprised to the upside over the past year, and further surprises could be in store.
Come
We
on,
therefore
Spy,
will need to be nimble
fucking
in responding
squeeze
to the
them.
incoming data and the evolving outlook. And we will strive to avoid adding uncertainty to what is already
right.
an extraordinarily challenging and uncertain time. We are highly attentive to inflation risks. The committee is determined to take the measures necessary to restore price stability. The American economy is very strong and well positioned to handle tighter monetary policy. To conclude, we understand that our actions affect communities, families, and businesses across the country.
It's always a rally,
Everything we
dude.
do
It was
is in
always a
service to our
rally.
public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Nick Chamaros of the Wall Street Journal. Chair Powell, the unemployment rate at 3.6% in March is now essentially at the level that the committee had expected would prevail over the next 3 years, and at the bottom end of FOMC participants' projections for the longer run rate that you submitted in the projections at the last meeting. How has your outlook for further declines in the unemployment rate changed since March? What does this imply for your inflation forecast? And how has your level of confidence changed with regard to the feasibility of slowing hiring without pushing the economy into recession? Thanks.
Thank you. So you're right. 3.6% unemployment is just about as low as it's been in 50 years. And I would say that I expect, and committee members generally expect, that we'll get some additional participation. So people will be coming back into the labor force. We've seen that, particularly among prime age people. And that will, of course, tend to hold the unemployment rate up a little bit. I would also expect, though, that job creation
Come on,
will
it's
slow.
fucking buying
job creation
here.
has been at more than 500,000 per month in recent months. Very, very strong, particularly for this stage of the
Pump
economy.
it, pal.
And so we think
Pump it.
with fiscal policy less supportive,
Here we go.
monetary policy less supportive, we think that job creation will slow as well. So it is certainly possible that the unemployment would go down further. So I would expect those to be relatively limited because of the additional supply and also just the slowing in job creation. Implications for inflation, really the wages matter a fair amount for companies, particularly in the service sector. Wages are running high, the highest they've run in quite some time, and they are one good example of, or good illustration, really, of how tight the labor market really is. The fact that wages are running at the highest level in many decades. And that's because of an imbalance between supply and demand in the labor market. So we think through our policies, through further healing in the labor market, higher rates, for example, of vacancy filling and things like that, and more people coming back in, we like to think that supply and demand
Nothing
will
holding
come
you
back
back
into
now.
balance, and that therefore
We know
wage
what the rate
inflation
hike is. There's nothing
will
holding
moderate
you
to
back,
still high
Spy.
levels of wage increases,
There's
but not
nothing.
ones that are more
It's
consistent
time.
with 2% inflation.
Let's go.
That's
Come on,
our
take the EMAs
expectation.
back. You
Your
gotta
third
take the
question
EMAs
was-
back.
Your level of confidence.
Gotta
that you
take
can
them
slow
back.
hiring
Let's go. Let's
without
go.
pushing
Let's
the
go. Let's
economy
go. Let's go.
into
Let's go.
So, I guess I
Gotta
would say
take
it
those
this way.
fuckers back.
It's
That was a
there's
huge
path.
buying
There's a
volume
path
right
by
there,
which
baby.
we would be able to have demand
It was always a
moderate
rally.
in the labor market,
Come on.
and therefore have vacancies come down without unemployment going up, because vacancies are at such an extraordinarily high level. They're 1.9 vacancies for
It's gotta
every
hold
unemployed
up
person,
though. We gotta
11.5
see the rally
million
hold, baby.
vacancies, 6 million unemployed people. So, and we haven't been in that place on the vacancy, sort of the vacancy unemployed curve, the Beveridge curve. We haven't been at that sort of level of a ratio in the modern era. So in principle, it
Taking
seems
those
as
fucking
though
EMAs
by
back, baby.
moderating demand,
Nasdaq's going. Let's
we
go.
could see vacancies come down and as a result, and they could come down fairly significantly, and I think put supply and demand at least closer together than they are, and that would give us a chance to have get inflation down, get wages down, and then get inflation down without having to slow the economy and have a recession and have unemployment rise materially. So there's a path to that. Now, I would say I think we have a good chance to have a soft or softish landing or outcome, if you will, and I'll give you a couple of reasons for that. One is households and businesses are in very strong financial shape.
Yes,
You're
say
looking
nice things, pal. Come on.
excess savings on
Spy's
balance
losing it.
sheets, excess in the sense that they're substantially
Come on,
larger than
Spy. We
prior
got to
trend.
take those EMAs back.
Businesses are in good financial
Don't
shape.
let them
The
cross
labor
over.
market
We're
is,
right at
as I
VWAP,
mentioned,
right
very,
at the
very
EMAs.
strong. And so it doesn't seem to be anywhere close to a downturn. Therefore, the economy is strong and is well positioned.
Middle class
to
is
handle
strong.
the type of
Yes.
policy. So,
Middle class
but
couldn't
I'll
be
say, I do
stronger.
expect
Holy
that this
fuck,
will be
no one can
very
afford a
challenging. It's
house,
not
but
gonna
we're
be easy.
good, dude.
And it may well depend, of course, on events that are not under our control. But our job is to use our tools to try to achieve that outcome, and that's what we're going to do.
Come on, the buying pressure's too strong, dude. It's too much.
Steve Leisman, CNBC.
Make the
Thanks
fucking
for
shorts
taking
cover.
my question, Mr. Chairman. You talked about using 50
Let's
basis
go,
point
let's go,
rate
let's
cuts, or
go.
the possibility of them in coming
Green
meetings.
dingus.
Might
Big
there be
old green
something
dingus.
larger than 50
Oh,
or
it's
75
rallying,
or a
baby.
percentage
It was
point
always a
possible?
rally.
And
It was
perhaps you could
always a
walk us through
rally.
your
You're seeing the way
calibration.
that candle's moving.
Why 1 month or one meeting should we expect at 50? Why something bigger? Why
It was
something
always
smaller?
going to be a
What
rally.
is
Come on,
the,
we got to
the
take
reasoning
420.
for the level?
It's got to be 420, baby. Come on.
Sure. So
Let's fucking
75
go.
basis point in an increase is not something the committee is actively considering.
It was always going to
What
be
we
a
are doing
rally.
is we raised 50 basis points today, and we've
Keep
said
saying
that,
nice things,
again,
pal.
assuming that economic and financial conditions evolve in
Let's
ways that are
go,
consistent with our
baby.
expectations. There's a broad sense on the committee that
Diamond
additional
hands. I ain't
50 basis
fucking
increases
selling
should
these
be
calls.
put to
I ain't
use
fucking
on
selling
the
them.
table for the next couple of meetings. So we're going to make those decisions at the meetings.
Holy shit, look at this buying volume,
Paying
baby.
close attention to the incoming data and the evolving outlook.
30
as
seconds
well as
left
the
on this
financial
candle. We
conditions.
gotta
And
hold those
finally, of course,
EMAs.
we will be
It's
communicating
gotta
to the
hold them.
public
Gotta
about
hold
what
them.
our
Or
expectations
just keep
will
going
be
up
as they
for all I
evolve.
care. Fuck it.
So the test
Damn,
is
look at that
really just,
volume.
as I laid it out, economic and financial
Oh.
conditions evolving broadly in line with expectations. And, I think the
Oh,
expectations are
Lord, give me
that
a
we'll
rally.
start to see
Jeebus,
inflation,
squeeze the shorts.
flattening out,
Squeeze.
and,
Come
not
on.
necessarily declining yet, but we'll see more evidence. We've seen some evidence that core
Apple,
PCE
you gotta hold
inflation
your EMAs,
is
Apple.
perhaps either reaching
Gotta
a peak
hold
or
'em,
flattening out. We
gots
wanna
to
know-
hold
we
'em.
want to know more than just some evidence. We want to really feel like we're making some progress.
This candle
there.
closes above those EMAs,
But,
and
mean,
okay, we
we're going to
did.
make these decisions, and
Wait,
there'll
what
be
happened?
a lot more information. I just think we want to see that information. as
there
we
it
get
is.
there.
Is
It's
this
a
shit
very
delayed?
difficult environment to try to give forward
420.
guidance
Give us
60, 90
420.
days in advance. There's so
Yeah,
many
give
things
us
that can happen
420.
in the
Spy
economy and around the
420.
world.
Every
So,
day.
we're leaving ourselves room to look
Yeah,
at the data
yeah,
and make a
yeah, yeah. Let's
decision as
go,
we get
baby.
there.
I'm sorry.
We're up 157 on these
Inflation
puppies.
is lower 1 month and the
More,
unemployment
baby,
rate higher. Would
more.
that be something that we would
More. We're not
calibrate
done yet.
towards the
Oh,
lower
we're just getting started,
increase
baby.
in the
That
funds
is
rate,
a
or
I don't
money.
think
We got
that
the
1
dip.
month-
We got the
1 month is
VWAP.
not
We got the
enough.
EMA
1 month's
confirmation.
reading doesn't tell
More.
us much.
It's got to be
Yeah,
more.
we'd want to see evidence that inflation is moving in a direction that gives us more comfort.
It's got to be
As I said,
420.
we've
We
got
reject
2 months
420 here, and
now
I'm
where core
taking I'm
inflation is a
TPing.
little lower, but we're not looking
taking
at
profits.
that as a reason to
Going
take
with the
some comfort.
TP.
I think we need to really see
Nasdaq's holding us back.
that
Come on.
our expectation is being fulfilled. That inflation, in fact, is under control and starting to come down. But again, it's not like we would stop. We would just go back to 25 basis point increases. It'll be a judgment call when these meetings arrive. But our expectation is if we
We're up
see what we expect to
165
see,
on
then
these.
we would have 50 basis point increases on the table at the next 2 meetings.
Boom. Confirmed it. 50 basis points, next 2 meetings. Now we know. We price it in. We know. We're good now.
Given the expectation that inflation will remain well above the Fed's target at year end, what constitutes a neutral policy setting in terms of the Fed funds rate? And to what extent is it appropriate for policy to
Oh,
move
let's
beyond
go.
that
It's
level, at some point
yes.
this year?
Oh, let's fucking go.
So, neutral. when we talk about the neutral rate, we're really talking about the rate that neither pushes economic activity higher nor slows it down.
421 more, baby. Give us
It's not something
422.
we can identify with any precision.
Fuck
So
yes.
we estimate it within broad bands of uncertainty, and the current estimates on the committee are sort of 2 to 3%. And also, that's a longer run estimate. That's an estimate for an economy
let's
that's
go.
full employment and 2% inflation. So really what we're doing is we're raising
All right, I'm
rates
selling 4.
expeditiously to what we see as the broad range of plausible levels of neutral. But we know that there's not a bright line drawn on the
Oh,
road
baby,
that
it's
tells
still
us when
going.
to get there. So we're going to be looking at financial conditions, right? Our policy affects financial conditions, and financial conditions affect the economy. So we're going to be looking at the effect of our policy moves on financial conditions. Are they tightening appropriately? And then we're going to be looking at the effects on the economy. And we're going to be making a judgment about whether we've done enough to get us on a path to restore price stability. It's that. So if that path happens to evolve levels that are higher than estimates of neutral, then we will not hesitate to go to those levels. We won't. But again, there's a sort of false precision in the discussion that we as policymakers don't really feel. You know, you're going to raise rates, and you're going to be kind of inquiring how that is affecting the economy through financial conditions. And of course, if higher rates are required, then we won't hesitate to deliver them.
Thanks, Chair Powell. Neil Irwin with Axios. Do you see evidence that inflationary psychology is changing, that in areas like workers' wage demands, businesses' willingness to raise prices, do you see evidence that there is a psychological shift going on inflation? Thanks.
So we don't really see strong evidence of that yet, but that does not in any way make us comfortable. I think if you look at short-term inflation expectations, they're quite elevated. And you can look at that and say, well, that's because people expect inflation to come down. And in fact, inflation expectations come down fairly sharply.
I'm that fucking guy, baby. Let's
are
go.
reasonably stable, but have moved up.
That's a
to
money
equivalent to
move right
levels where
there.
they were in
Fuck yeah.
2014 by some measures. So you can look at that, and I think that's a fair description of the picture. But it's really about the risks. We don't see a wage price spiral. We see that companies have the ability to raise prices, and they're doing that, but there have been price shocks. So I just think it takes you back to the basic point, was that we know we need to expeditiously move our policy rate up to ranges of more normal neutral levels, and we need to look around and keep going if we don't see that financial conditions have tightened adequately, or that the economy is behaving in ways that suggest that we're not where we need to be. So you don't see those things yet, but I would say there's no basis for feeling comfortable about that. It's a risk that we simply can't. We can't run that risk. We can't allow a wage price spiral to happen, and we can't allow inflation expectations to become unanchored. It's just something that we can't allow to happen, and so we'll look at it that way.
Gina.
Gina Smiley with the New York Times.
Baby.
You mentioned in your
Hyped.
statement that
God, I'm
both
fully
of us are
bricked
risks
up.
to inflation from Russia and China. Obviously, those are very much supply shocks rather than demand side. And I wonder what you meant to convey by adding them. I wonder what you meant to convey by adding those.
Well, so our tools don't really work on supply shocks. Our tools work on demand. And to the extent we can't affect really oil prices or other commodity prices or food prices and things like that. So we can't affect those. But there's a job to do on demand. And that you can see that in the labor market, where demand is substantially in excess of supply of workers. And you can see it in the product markets as well. But I guess I'm just pointing out that a couple of things. For both the situation in Ukraine and the situation in China, they're likely to both add to headline inflation, and people are going to be suffering from that. You know, people almost suffer more from food and energy shocks but even though they don't actually tell us much about the future path. So, but the second thing is that they're both capable of preventing further progress in supply chains healing, and so, or even making supply chains temporarily worse. So they're going to weigh on the process of global supply chain healing, which is going to affect broader inflation too. So in a way, there are two further negative shocks that have hit really in the last, 60 days, 90 days.
Hi, Victoria Guida from Politico. I want to follow up on that because you all have obviously highlighted that there are both supply and demand issues at play in inflation. And I'm just wondering, if these supply chain issues continue because of Russia, because of China, or just because these things take a while to work out, does getting back down to your 2% mandate require that these supply chain issues get resolved, since you can only handle the demand side, as you said, or will you have to crimp demand maybe even further if the supply chain issues don't resolve themselves in order to try and get inflation back down to where you want it to be?
So, I'll just say for now, we're focused on doing the job we need to do on demand, and there's plenty to be done there. Again, if you look at it, it's essentially almost 2 to 1 job vacancies to unemployed people. There's a lot of excess demand. There are more than 5 million more employed plus job openings than there are the size of the labor force. So there's an imbalance there that we have to do our work on. It's a very difficult situation if you can't, you would look at core inflation, which wouldn't include the commodity price shocks, and that's one of the reasons we would tend to focus on that, because we can have more of an effect on that. But it would be a very difficult situation. I mean, we have to be sure that inflation expectations remain anchored, and I mean that's part of our job too. So we'd be watching that carefully, and it puts any central bank in a very difficult situation.
Howard Schneider with Reuters, and thanks, and nice to be back. Two questions, one quick one. You cited the 1.9 to 1 figure so often now. I got to ask you, what would be a good figure there? What would you like to see that come down to think that you're at sort of a non-inflationary vacancy to unemployed rate? And secondly, on help from inflation, how much are you counting on wealth effects through stock market channels? Equity markets broadly down quite a bit since late fall, first of the year. How are you mapping that into household consumption? Have they come down enough? Do you need another leg down in equity values to think that households are going to stop spending at the rate you need them to stop spending?
Okay, so in terms of the vacancies to unemployment ratio, we don't have a goal in mind. There's no specific number that we're saying we got to get to that. It's really you've got to get to a place where the labor market appears to be more in balance, and that depends not only on the level of those things. It depends on how well the matching function in the labor markets are working, because the longer these expansions go on, you can get very efficient with all of that, and the Beveridge curve shifts out, and that also tends to help. So there isn't a specific number. I will say we were at, I think when we got to 1 to 1 in the late teens, we thought that was a pretty good number. But again, we're not shooting for any particular number. What we'd like to see is progress, but we're not really looking at that. That's an intermediate variable. We're looking at wages, and we're looking at ultimately inflation. So there are a bunch of channels through which policy works. You can think of it as interest-sensitive spending, and then you can think of another big one as asset values broadly. And there are big models with a lot of different channels that are related to that. We don't focus on any one market, the equity market or the housing market, or we focus on financial conditions broadly. So we wouldn't be targeting any one market, as you suggest, for going up or down, or taking a view on whether it's at a good level or a bad level. We just would be looking at very broad measures of financial conditions, all the different financial conditions indexes, for example, which include equity, but they also include debt and many other things, credit spreads, things like that too.
Rachel.
Hi, Chair Powell. Rachel Siegel here from the Washington Post. To follow up from your message from the very beginning, what is your message to the American people about when they will start to feel the effects of, say, the 50 basis point rate hikes or multiple hikes? How do you explain to them what that does to their grocery bill or their rent or their gas bill? Thank you.
So the first thing to say is that we understand, and some of us are old enough to have lived through high inflation, and many aren't, but it's very unpleasant. It's just something people don't, when they experience it for the first time. You're paying more for the same thing. If you're a normal economic person, then you're probably don't have that much extra, to spend, and it's immediately hitting your spending on groceries, on gasoline, on energy and things like that. So we understand the pain involved. So how do you get out of that? And it's our job to make sure that inflation of that unpleasant high nature doesn't get entrenched in the economy. That's what we're here for. One of the main things we're here for. Perhaps the most fundamental thing we're here for. And the way we do that is we try to get supply and demand back in sync with each other, back in balance, so that the economy is under less stress and inflation will go down. Now, the process of getting there involves higher rates, so higher mortgage rates, higher borrowing rates, and things like that. So it's not going to be pleasant either, but in the end, everyone is better off. Everyone, particularly people on fixed incomes and at the lower part of the income distribution, are better off with stable prices. And so we need to do everything we can to restore stable prices. We'll do it as quickly and effectively as we can. We think we have a good chance to do it without significant increase in unemployment or really sharp slowdown. But ultimately, we think about the medium and longer term, and everyone will be better off if we can get this job done. The sooner the better.
Thank you, Chair Powell. Edward Lawrence with the Fox Business Network. So you've talked in the past about consumer spending and how that's drives the economy. Are you concerned with this high level of inflation that the consumer will stop spending, pushing us into, and what's the level of your concern, pushing us into a recession?
So the economy is doing fairly well. We expect growth to be solid this year, and we see household spending and business investment as fairly strong even in the first quarter, which was relatively slow on some other fronts. So, and the labor market. If you look at the labor market, for people who are out of work and looking, there are lots of job opportunities. For wages are moving up at rates that haven't been seen in quite a long time. So it's a good time to be a worker looking to either change jobs or get a wage increase in your current job. So it's a strong economy, and nothing about it suggests that it's close to or vulnerable to a recession. Now, of course, given events around the world and fading fiscal policy effects and higher rates, you could see some slower economic activity. Certainly, it will not be. Last year was an extraordinarily
going up in the power hour. Are we still going to rally?
Pandemic, as I mentioned, growth over 5%. But most forecasters have growth this year at a solid pace, above 2%.
But we've talked with economists who have advised Democrats and Republican presidents, who both said that the Fed is so far behind the curve on inflation that a recession is inevitable.
So, and as I said, I think we have a good chance to restore price stability without a recession, without a severe downturn, and without materially higher unemployment. And I mentioned the reasons for that. So I see a strong economy now. I see a very strong labor market, for example. Businesses can't find the people to hire. They can't find them. So typically in a recession, you would have unemployment. Now you have surplus demand. So there should be room, in principle, to reduce that surplus demand without putting people out of work. The issue will come that we don't have precision surgical tools. We have essentially interest rates, the balance sheet, and forward guidance, and they're famously blunt tools. They're not capable of surgical precision. So I would agree. No one thinks this will be easy. No one thinks it's straightforward, but there's certainly a plausible path to this, and I do think we've got a good chance to do that. And our job is not to rate the chances. It is to try to achieve it. So that's what we're doing. There are a range of opinions, though, and that's only appropriate.
Steve Dorsey.
Thanks, Steve Dorsey, CBS. You mentioned earlier just now fading fiscal policy. Do you feel that the Fed has been supported enough from policies at the White House and in Congress in combating inflation?
You know, it's really the Fed that has responsibility for price stability, and we take whatever arrives at the Fed in terms of fiscal activity, we take it as a given, and we don't evaluate it. We don't. It's not our job, really. We don't have an oversight function there, and we look at it as our job to, given all the factors that are happening, to try to sustain maximum employment and price stability. So, if the Congress or the administration has ways to help with inflation, I would encourage that, but I'm not going to get into making recommendations or anything like that. It's really not our role. We need to stay in our lane and do our job. When we get inflation back under control, then maybe I can, give other people advice. Right now, we need to focus on, just focus on doing our job, and I'll stick to that, stick in our lane.
Steve Matthews with Bloomberg News. A number of your colleagues have said that rates will need to go above neutral into a restrictive territory to bring down inflation. One, do you agree with that? And two, you recently spoke in great praise of Paul Volcker, who had the courage to bring inflation down with recessions in the 1980s. And while it's certainly not your desire, and the soft landing is the big hope of everyone, would this FOMC have the courage to endure recessions to bring inflation down if that were the only way necessary?
So I think it's certainly possible that we'll need to move policy to levels that we see as restrictive as opposed to just neutral. We can't know that today. That decision's not in front of us today. If we do conclude that we need to do that, then we won't hesitate to do it. I'll say again, there's no bright line, that you're stepping over. You're really looking at what our policy stance is and what the market is forecasting for it. You're looking at financial conditions and how that's affecting the economy and making a judgment. We won't be arguing about whose model of the neutral rate is better than the other one. It's much more about a practical application of our policy tools. And we're absolutely prepared to do that. Wouldn't hesitate if that's what is taken. So I am, of course, who isn't an admirer of Paul Volcker? I shouldn't be singled out in this respect, but I knew him just a little bit and have tremendous admiration for him. But I would phrase it this way. He had the courage to do what he thought was the right thing. That's what it was. It wasn't a particular thing. It was that he always did what he thought was the right thing. If you read his last autobiography, that really comes through. So that's the test is, it isn't will we do one particular thing. I would say we see restoring price stability as absolutely essential for the country in coming years. Without price stability, the economy doesn't work for anybody, really. And so it's really essential, particularly for the labor market. If you think about it, if you look at the last cycle, we had a very, very longest expansion cycle in our recorded history. And in the last 2-3 years, you had the benefits of this tight labor market going to people in the lower quartiles, and it was, racial wealth and income, not wealth, but income gaps were coming down, wage gaps. So it's a really great thing. We'd all love to get back to that place, but to get back to anything like that place, you need price stability. So we've been hit by historically large inflationary shocks since the pandemic. This isn't anything like regular business. We have a pandemic. We have the highest unemployment, since the Depression. Then we have this outsized response from fiscal policy and monetary policy. Then we have inflation. Then we have a war in Ukraine, which is cutting the commodity, patch in half. And now we have these shutdowns in China. So it's been a series of inflationary shocks that are really different from anything people have seen in 40 years. So we have to look through that and look at the economy that's coming out the other side, and we need to somehow find price stability out of this. And it's obviously going to be very challenging, I think, because you do have numerous supply shocks which are famously difficult to deal with. So I guess that's how I think about it.
Hey, Chris.
Thank you. Chris Rugaber at Associated Press. Earlier, you just said that if necessary, I think were the words, that you would, or if it turned out to be necessary, or you said it's possible that we'll need to move policy to restrictive levels. Given where inflation is and the hot economy is, or certainly the hot labor market as you described it, why still the hesitation? I mean, shouldn't it be, what else do you need to see in order to determine that? Wouldn't the Fed naturally be looking to go to a restrictive level at this point? Thank you.
So if I said necessary, I meant to say appropriate. We're not going to be erecting a high barrier for this. It's more if we think it's appropriate. You know, the point is we're a very long way from neutral now. We're moving there expeditiously, and we'll continue to do so. And we can't make that decision really today. The decision about how high to go will be on the table to be made when we reach neutral. And, you know, I expect we'll get there expeditiously, as I've mentioned. So it's not that we don't want to making that decision today wouldn't really mean anything. But I'll say again, if we do believe that it's appropriate to go to those levels, we won't hesitate.
Mike McKee from Bloomberg Television and Radio. The balance sheet, why did you decide to wait until June 1st to begin letting securities roll off and not immediately start in the middle of this month, say? And do you have a newer or a better estimate for the monetary policy impact of letting the balance sheet decline? And then finally, I'm just curious why you felt the need to address the American people at the top of your remarks. Are you concerned about Fed credibility with the American people?
So why June 1? It was just pick a date, you know, and that happened to be the date that we picked. It was nothing magic about it. You know, it's not going to have any macroeconomic significance over time. We just picked that. Sometimes we publish these calendars on the first day of the month, and that's what we're doing. I wouldn't read anything into it. In terms of the effect, I mean, I would just stress how uncertain the effect is of shrinking the balance sheet. You know, we run these models, and everyone does in this field, and make estimates of what will be the how do you measure, you know, a certain quantum of balance sheet shrinkage compared to quantitative easing. And, you know, these are very uncertain. I really can't be any clearer. There won't be any clearer. You know, people estimate that broadly on the path we're on, and this will be taken probably too seriously, but sort of 1/4%, one rate increase over the course of a year at this pace. But I would just say with very wide uncertainty bands, very wide. We don't really know. There are other estimates that are much smaller than that, by the way, and some of you may have read about that. That's kind of a mainstream estimate. We know that it is part of returning to more normal, more neutral financial conditions. And, you know, our strategy is to set up a plan and have it operate, and really have the interest rate be the active tool of monetary policy. In terms of speaking to the American people, I feel like sometimes I want to remind us really that that's who we work for, and that it's inflation that people are feeling all over the country, and it's very important that they know that we know how painful it is, and that we are working hard on fixing it. I thought it was quite important to do that, and so that was really the thinking behind that.
Do you think the Fed has a credibility problem?
No, I don't. And a good example of why would be that, so in the fourth quarter of last year, as we started talking about tapering sooner and then raising rates this year, you saw financial markets reacting, you know, very appropriately. Not to bless any particular day's measure, but the way financial markets, you know, the forward rate curve has tightened in response to our guidance and our actions, really amplifies our policy. I mean, it's monetary policy is working through expectations now to a very large extent. We've only done 2 rate increases, but if you look at financial conditions, the 2-year is at 280 now. In September, I think it was at 20 basis points, and that's all through the economy. People are feeling those higher rates already, and so that shows that the markets think that our forward guidance is credible. And I think that's We want to keep it that way.
Scott Horsley, did you have your hand up? Okay. Brian, Chung.
Hi there, Brian Chung with Yahoo Finance. To expand on Steve's question about Paul Volcker, there was also a great pain that came with that as well. Higher interest rates obviously affecting households and businesses, and wondering how you kind of square what might be demand destruction. Are you already seeing that? Is the idea here to incentivize a lack of spending, to decrease consumption, to perhaps table business investments? Is that essentially what's happening through this hiking cycle? Thanks.
Well, so as I mentioned, you can see places where their demand is substantially in excess of supply, and what you're seeing as a result of that is prices going up and at unsustainable levels that are not consistent with 2% inflation. And so what our tools do is that as we raise interest rates, demand moderates and it moves down. Interest rates, businesses will invest a little bit less, consumers will spend a little bit less. That's how it works. But ultimately, getting supply and demand back in balance is what gives us 2% inflation, which is what gives the economy a footing where people can lead successful economic lives and not worry about inflation. I mean, so yes, there may be some pain associated with getting back to that, but the big pain is in not dealing over time, is in not dealing with inflation and allowing it to become entrenched.
Thank you. Thank you, Chair Powell. Greg Robb from MarketWatch. I was wondering if you could take a step back and talk about, in March, the dot plot had, steady, it looked like steady quarter-point rate hikes, get the funds rate up to 2% at the end of the year. Now, it seems like you're much more aggressive. So could you talk about the thinking that's behind that? Thank you.
So, look, I think what you've seen is really, I would say, last fall, in the middle of last fall, there was a time when our policy stance was still pretty much in sync with what the data were saying. If you remember, there were a couple of weak jobs reports, and inflation had actually come, month by month inflation had come down till September, a few months in a row, stayed low. And then around the end of October, we got three or four really strong readings that just said, no, this is a much stronger economy. And by the way, then with the restatement of the jobs numbers, it looked like the job market was much more even and stronger in the second half of the year, but that hadn't happened yet. Anyway, we got an ECI reading, Employment Compensation Index reading, the Friday before the November meeting. Then we got a really strong jobs report. Then we got a really high CPI report. And so I think it became clear to the committee that we needed to adjust and adapt. And we have. Ever since then, really ever since then, we've been adapting. The committee moved by the time of the December meeting to a meeting of 3 rate increases, then to a meeting of 7 rate increases at the March meeting. And that process is going on, and it's clearly continuing. And that's why I say, and I actually mentioned this at the March meeting, that no one should look at any single SEP as sort of a real resting place for 90 days, because we're in a fast evolving situation, and that's what's happened. You can see, unanimous vote today, of course, and I told you the guidance that broad support on the committee to have 50 basis point hikes on the table at the next couple of meetings. So you're right, and by the way, other forecasters have been doing the same thing. And it's just us adapting to the data and to the situation and using our tools to deal with it.
Thanks. We'll go to Nancy for the last question.
Hi, Nancy Marshall-Genzer with Marketplace. Chair Powell, I want to ask how you're able to balance your dual mandate, stable prices and maximum employment, especially when the unemployment rate for black workers is still roughly twice the rate for
what about the black workers?
So unemployment rates for all racial groups have come down a lot and are now much closer to where they were before the pandemic hit. So that's one thing I would say, and that's important. But the bigger point is this: I do not at this time see the two sides of the mandate as in tension. I don't. Because you can see that the labor market is out of balance. You can see that there's a labor shortage. There aren't enough people to fill these job openings, and companies can't hire.
Good God,
and-
AMD, are
and,
you fucking high?
And wages are moving up
Holy
at levels
shit,
that would not,
AMD,
over
let's
time,
go.
be consistent with 2%
Damn, boy.
inflation over time. And of course, everyone loves to see wages go up, and it's a great thing, but you want them to go up at a sustainable level, because these wages are, to some extent, being eaten up by inflation. So what that really means is, to get the kind of labor market we really want to get, we really want to have a labor market that serves all Americans, especially the people in the lower income part of the distribution, especially them. To do that, you've got to have price stability. And we've got to get back to price stability so that we can have a labor market where people's wages aren't being eaten up by inflation, and where we can have a long expansion too. That's the good thing, is you can have, as we have, we've had several of the longest expansions in US history have been in the last 40 years, and that's because it's been a time
That
of
would've been
low
another
inflation.
400
And long
bucks, but
expansions
oh well.
are good for people and good for the labor market. So that's the way I think about it. I think we, our tools work. We have to think in the medium and longer term, and I do think that the best thing for everyone is for us to get back to price stability to support really a sustained period of strong labor market conditions. Thanks very much.
Alright. Pal's done pumping. Hold this up. What a fucking face ripper, baby. Oh, shit. Damn, AMD. Holy, AMD's nuts. Shit, dude, I wish I held that fucking call. Oh my god. What's it at now? Ooh, fuck. That one ran almost 100% too. Dana Pink. Holy shit, Spy, chill. It just won't stop. Why is oil pumping? Fuck. Jeez, oil is hamping. Wow. Wow. baby. Holy. Spy just keeps going. What the fuck? What the shit? Oh my god, Spy. What? This is kind of nuts, dude. What is going on? Holy shit, Spy. Wow, this is craziness. It just keeps going up. It just keeps going up. Oh, it did fill that gap. Wow. Okay. Gap is filled. And I have a not really inverse head and shoulders. Sorta kinda. NASDAQ. Fuck, man. NASDAQ is reclaiming that. Holy fuck, dude. What is going on? This is nuts. Spy cannot be stopped. Oh my god. This is craziness. This is like, holy shit. Mother of all fucking short squeezes right now, baby. Wow.